Growth stock investors put themselves in an excellent position to reap the benefits of compounding over time. However, one of the more difficult challenges of investing in growth stocks is forecasting the rate of growth of a given investment and comparing it to the price you're paying for the stock today. A general rule of thumb I like to recommend for non-professional investors to consider is the expected rate of earnings per share growth over the next 5 years, divided by the forward price to earnings ratio of the investment in consideration. If that number is over 1, you've identified a stock that's worth looking deeper into. Because, of course, just one metric alone isn't enough to make an investment decision. Now, I've done a great deal more research into growth stocks, and I created a list of my top 9 growth stocks to consider right now in September, and I'll share them with you in this video. As a bonus, I'll reveal how these stocks have performed compared to the S&P 500 index this year. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, my top 9 growth stocks right now are NVDA, Chewy, Amazon, Snap, Fiverr International, Uber Technologies, Salesforce, PayPal, and Alphabet. And you'll notice I've posted the forward price to earnings ratios of each of these stocks I mentioned. And the most expensive here is Amazon at a forward PE of 30.8 and NVIDIA at a forward PE of 30. In fact, if you look at NVIDIA's expected earnings per share growth rate over the next 5 years, that number is well ahead of 40%. So you're getting a much higher earnings per share growth rate for NVIDIA over the next 5 years compared to the forward PE. And if you were to do that exercise with all of these stocks I mentioned here, you're likely to find a very favorable number. And if not, there are particular reasons why I've still selected these stocks, even if the expectations of forward EPS over the next 5 years are not quite as favorable as in the NVIDIA example. Still, I use that as one of the top metrics when evaluating growth stocks to determine if they make a worthwhile investment or not. Sometimes growth stocks may have excellent prospects, but their valuations might be so rich that they've already incorporated very much of those prospects into the price, where it leaves little for investors to gain in the long run. Now, these stocks I've listed here, they're in no particular order. In fact, my top stock to buy in 2024 has been Alphabet, and Alphabet has been my top stock to buy all year, and it's listed here at the very bottom of the list. So I don't mean this list to be in order of preference. It's just a list of my top 9 growth stocks right now in September of 2024. If we look at the performance of these stocks year to date in 2024, you'll notice the best performing stock is NVIDIA, no surprise here, at 141% year to date. And the worst performing stock is Snap at negative 44.8% year to date. You'll notice that only 3 of these stocks are down, while the rest of them are up on the year. And the loss being the biggest for Snap at negative 44, while the gain being the biggest for NVIDIA at 141%. Now, an interesting note that I always make when I'm covering NVIDIA stock is some investors are concerned that NVIDIA stock is too expensive because it's already increased by so much. But what I highlighted already is it's not how much the price has increased or the market price of the stock that makes a stock expensive or cheap. But what makes a stock expensive or cheap is what you're getting in return when you're comparing the price to something fundamental about the business. The price to earnings, the price to free cash flow, the price to sales, maybe the book value. And so you can't judge an investment solely on the base of the market price because you don't know what you're getting in return. If I were to ask you, is Coca-Cola, actual Coca-Cola at the grocery store for $2, is that expensive or cheap? And you should be able to answer me and say, well, I don't know yet. Are you talking about the 2-liter bottle of Coca-Cola for $2 or a 24-pack of 12-ounce cans for $2. That makes a big difference, right? What you're getting in return to the price you're paying. And that's very similar to when you're making investments in growth stocks is what are you getting in return for the price that you're paying? And for this list of growth stocks I've highlighted, you're getting a lot in return for the price that you're paying. These stocks are not expensive when measuring on the forward price to earnings basis. Now, as I highlighted, I'll compare how these groups of stocks have performed against the S&P 500 index, which is having an incredible year. The S&P 500 has returned 19.31% to investors year to date in 2024. I think all of us should be happy with this kind of return for investing in the S&P 500 index. You shouldn't expect this to happen from the S&P 500 every year. In fact, this is rare. You should expect roughly half of this from the S&P 500 index on an annual basis. An average annual return of 19% would be significantly outperforming its historical average. So now let me share with you the portfolio return year to date in 2024. These portfolios of top 9 growth stocks have returned 19.58% year to date, compared to the S&P 500 at 19.31%. So my portfolio of stocks has outperformed the S&P 500 index by 0.27 percentage points. Not a huge outperformance at all. And in fact, this outperformance has fluctuated throughout 2024. There have been times when this portfolio has significantly outperformed the S&P 500 index and times when it had underperformed the S&P 500 index. I would expect that over time, my portfolio of stocks will only slightly outperform the S&P 500 index, if at all. And that's a result of the S&P 500 index being a collection of the entire market, and these stocks being a collection of just 9. And the S&P 500 index is market weighted, whereas the portfolio return I'm reporting here is equal weighted. So I'm not getting a greater weight for the NVDA stock pick at 141%, but the S&P 500 index is getting an overweighted calculation of NVIDIA stock as a percentage of the total S&P 500 index return. And so those calculation differences will weigh on these comparisons, and so it's not like an apples to apples comparison at all. This is just for informational purposes, just so you can see how these stocks would have performed against the S&P 500 index. As always, I recommend you do further due diligence before selecting any of these stocks. I have dozens and dozens of videos of all of the stocks I've mentioned in this video. I've been following all of these stocks for years, and I have even beyond videos. If you look back to my days as a writer on the Motley Fool, I've got articles about these stocks. So dig deeper, do more research. This is too short of a video to include everything you need to know about deciding on any of these stocks. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.